right, everybody, we are back. Happy New Year. Couple week hiatus there over the holidays for the $1,000,000 question, but we are back and excited for 2026. So today, as we previewed a little bit on the morning show there with Steve and Sean, we're going to be talking about the way that we here at Reveille like to do regular reviews of our portfolio strategies, the ways that we think that investors out there, other financial advisors could spend as little as 10 minutes a month to really make sure that their investments are aligned with the prevailing trends in the market. And as I mentioned to Steve as we were signing off on the morning show, in my career, the times that I have gotten hurt in my investing journey have been the periods where I have not aligned with the primary trends in the market. I had a thesis, I had an idea of what I thought should happen, and I might have been right over time, but I had to experience some pretty significant pain along the way that much of it could have been avoided if I simply had aligned with the primary trends in the market, and ultimately had maybe a better entry into those trades. But just from an emotional standpoint, it's so much easier to just say, I'm going to spend time trying to discern what the trends in the market are. What's the trajectory of the things that I'm invested in? I still want to have a diversified portfolio. I still want to be asset allocated, but do I need to be fully invested in this market? Do I need to be fully invested all the time? We kind of talked about that in the show a couple weeks back, where we were talking about market timing and how where it's impossible to time the market, it is very feasible to discern a trend and align yourself with that trend. And sometimes that means making a change to the way that you're positioned when that trend changes. But it's at that point, it's no longer a guess. It's not a hunch. It's not some intuition. It's making changes as changes happen, right? So it goes back to that old saying of, you know, when facts change, I change my mind, right? What do you do, sir? So it's about doing that with your portfolio, with your investments when trends change. So we're going to talk about what some of the trends are in the market right now. And then we're going to talk about some ideas for 2026 where I think that there is some meaningful change that is coming to some of the relative trends that have been in place for many, many years. And a lot of investors are positioned as if those things will just continue ad infinitum, but things be changing. And you need to make sure that you're making some of these adjustments within your investments, within your 401k. So we're going to be talking about that a little bit today. So let's jump in here, and we're going to begin looking at the S&P 500 index. So we're going to go through just the core sector allocations, maybe the size, not so much style, but we're going to look at the size here, different asset classes. U.S. large cap, we'll look at mids, smalls, we'll look at international, emerging markets, commodities, real estate, bonds, all of the building blocks of a diversified portfolio, the manner in which we do, to where you could simplistically say, is this thing moving up or is it moving down? And based on whatever the answer to that question is, what change might I need to consider making in my portfolio, right? So we're looking at the S&P 500, and it is definitely in an uptrend. The trajectory of the price move in the S&P is up and to the right. Went out 2025 at all-time highs. Certainly had a change in the primary trend earlier in the year, right? Back in March of 2025. I certainly want to point that out. March of 2025 is when the primary trend of the S&P went from higher to lower. That's about a month before the Liberation Day sell-off happened. But by May, the primary trend had flipped again and was back to being up and to the right, where we would say that investors certainly need to be positioned uh, in this market. They need to own U.S. stocks, particularly large cap U.S. stocks, because they're making money, right? But this is where I said I think we've got some rotation that's going to be underway. This is a big deal, and we're going to talk about it in a couple of different ways throughout our discussion today. But we're looking at the relative trend between large cap growth stocks and large cap value stocks. And we are looking at a 18-year period of time almost, of which large cap growth stocks have been outperforming their large cap value counterparts as on a primary trend, right? There certainly were periods, 2021, 2022 was certainly a period where value had its day in the sun, but those growth stocks really dug in and took off back higher. But we are now at a very important level here. If you've been following the All-Star Charts crew, and you know that this is the All-Star Charts platform is about embracing technical analysis, that if we're looking at the down move, right, from the peak in this ratio in 2000 down to where it troughed out in 2006, 2007, the 161 extension, Fibonacci extension of that entire drawdown, right, would have targeted this level right here. And we have gotten just above that. I think we need to be on failed breakout watch here. We start to see this back underneath these levels, and that's just confirmation of the fact that we have got a relative trend change at hand. So I think that is a big change here for 2026 that we want to be watching. We don't have to talk about things like valuations or earnings growth or dividend yield or anything like that. We're just saying from a historical perspective, large cap growth stocks are as extended relative to their value counterparts as they've essentially ever been. We are very close, I think, to potentially putting in a failed breakout in that ratio. And if we end up back down here, there's going to be some material changes that are unfolding in the market. So we're gonna talk about some of the other rotations that we're seeing outside of our borders here in just a little bit. As a matter of fact, let's get right into it here. So 2025, first year of Trump 2.0, and all of the fear, concern, anxiety that investors had, that the sell side analysts had, should Trump win re-election in 2024, was that it was going to be a bad outcome for international markets. And so international stocks were selling off going into the election in 2024. They continued to sell off afterwards. We saw this outperformance from U.S. equities. This is S&P relative to the EFA index. So we saw a lot of outperformance going into the election in November of 2024. But surprisingly, that level of outperformance, it climaxed merely weeks after the U.S. election actually had or when we had results from the 2024 election. If we go back and check our monthly updates that we're sharing with our clients and now with the public on YouTube, on our YouTube channel, we were asking the question in December of 24 and even early in 25, in 2017, where there were big concerns around tariffs, trade wars, and these were reasons why you did not want to own international stocks. Well, international stocks outperformed in 2017. And we were asking the rhetorical question of, this setup seems so familiar. We've seen this story before. International stocks selling off, certainly relative to their U.S. counterparts, on concerns over tariffs and trade wars. But, we had strong dollar at the same time. We're not going to get into currency today, but dollar was strengthening at the same time, kind of driving that rotation out of the international space, or at least acting as a headwind for it. But wouldn't you know that by the time Trump actually took office, when he was sworn in January of 2025, that trend had already started to roll over in favor of international equities. And we saw international equities outperform handily in 2025. Now, when we zoom out, we see that, yeah, U.S. equities underperformed in 2025, but the primary trend here, it is still in favor of U.S. equities. But this very well may be another one of these that in 2026 makes a secular change. So we are looking for confirmation of this ratio to roll over and tell us that now our capital will be better served, not invested in large cap U.S. stocks, maybe not the cap weighted S&P 500 index, but we're going to be better off going overseas. And that has not been the case since the early days of my career. Now, I remember I came into this business in 2006. So I'm going into year 20 right now. But I would sit down with clients and prospective clients in the early days of my career, and you're helping them look at their 401k. And at that time, they were littered with international growth, emerging markets, Latin America. This stuff was red hot. Nobody wanted these lousy S&P 500 index funds. They sucked. Nobody wanted that. But how the tables have turned. Now nobody wants to own this other stuff. They don't want to own international. They can tell you the list of problems that Europe has, that Japan has, that China has, all the reasons why you don't want to own these things. But as I had a conversation with my friend Larry McDonald, and I'm going to try to get Larry to come and join us in the next couple of weeks to give a 2026 outlook. But Larry and I were into the energy stocks back in 2020, and man, they were getting hammered, and especially post-election in 2020, after Biden won, there was this real palpable concern of, well, Biden's going to do, or he's going to shut down the energy industry. We're going to ban the fossil fuels. That was the concern. And U.S. energy stocks were bottoming on that news, and post-election, they started ripping. And I remember being on the phone with Larry saying, sometimes the boogeyman turns out to be Santa Claus. And it was the same story here with international stocks. All the reasons that people were concerned about owning them, why you should not own them, provided a fabulous entry point into this space in late 2024, early 2025, and they were off to the races. All right, let's keep moving here. So we looked at this ratio on a cap-weighted basis. But when we look at it on an equally weighted basis, where we're stripping out the largest names from really dominating the index, which is a problem, by the way. But we see that when we compare international stocks to the median large cap U.S. stock, the equally weighted S&P 500 index, we see that trend has already rolled over in favor of international. And we see that primary trend, just as we saw with the cap weighted S&P relative to international, it outperformed for 13, 14 years, and now rolled over in 2025. I would say this is a confirmed downtrend as far as I am concerned, as far as we are concerned here at Reveille. This is a relative sell signal for the median U.S. stock relative to international. Now, I said that the concentration in the S&P itself and cap-weighted S&P is a problem. I do think it is a real problem. I got this from the J.P. Morgan Guide to the Markets. Fantastic piece of research, by the way. If you're familiar with it, if you're not, it's free. It's put out by their asset management division. They've got 70, 75 charts that they put out there on some of them they update monthly. A lot of it's quarterly type stuff. But there's a lot of really good information that is already compliance approved that you can use to review things with your clients. This to me is unbelievably eye-opening. So we're looking at the 10 largest components of the S&P 500 index at the beginning of 2025, and then every preceding decade ending in 5. And we can see that historically, you maybe get to 20%-ish somewhere in there. If we had this on the O's, if we had it on 80, 90, 2000, 2010, we would see it in 2000. This number was about 25%. We're at 40 right now. The 10 largest components within the S&P 500 index account for 40% of the market capitalization. That is extraordinary. And it is an extraordinary risk, in my opinion, because as we can see here, how often do the names on these lists change? They do change, right? So if we went back to, I know we don't have 2000 on here, but let's use 2005. Exxon and GE were the two largest companies in the S&P 500 index. Exxon and GE. Neither one of them are in the top 10 now. Right? As a matter of fact, I'm pretty sure both of them have been kicked out of the Dow Jones Industrial Average. That happened for Exxon in 2020. I don't remember exactly when GE got kicked out. But GE in 2000 was the largest company in the world, the largest publicly traded company in the world. And pull up a chart of GE when you get a minute. It has just recently, I'm talking about in the last several months, eclipsed its former high from 2000. 25 years worth of no progress. That is not, it's not uncommon that we talked about it in our last $1 million question, that trees don't grow to the sky. These are great companies, but the market can get way ahead of itself. It can impute way too much goodwill into these names. What happens to the S&P 500 index if, or I should say when, a similar outcome would befall a number of the components that are in here right now? I think that's a major headwind for the S&P 500 index, right? And when we saw that chart of growth versus value, looks like it is potentially putting in a top and could fall down in favor of value, where the value stocks are outperforming. I'm going to tell you, that's not great news for the S&P 500 index, because its largest components also happen to be the largest components of the growth index, right? So not great. So again, on a median view, looking at the median U.S. stock, the equally weighted S&P 500 index, it's already rolled over relative to international. My sense is that the cap-weighted index is going to catch up and confirm. Now, let's talk about kind of the outlook here for 2026, since we've been looking at the S&P, and then we're going to continue on with some other asset classes. before we wrap up today. But we're in year 2 of the 4-year presidential cycle. It is the worst of the 4 historically. Now, that's not to say that it's bound to be lower, because it's not on a historical basis, but it is the most volatile. And so we do have, in the near term, we need to remind ourselves we are still we're in the middle of the most bullish 6 months of the year. From November through the end of April are the best 6 months of the year historically. So we kind of see that corroborated here, that, this chart typically peaks in and around April, May, somewhere in there. You kind of get a little sell off January, February-ish, peak there, April, May. And then Q2 and 3, pretty rough, maybe. It's going to be more volatile. But then the carrot is that from Q4 through the first half of 2027, or what would be year 3 of the 4-year cycle, is the most bullish. Okay. Now, I cannot stress enough that these analog charts, they're good. They provide us with some good information. But this is not the gospel. This is not to say that this is how the market is going to unfold. So we don't want to blindly follow these things. We still want to follow the market trends. But should we be surprised if the market trends end up being somewhat correlated with these 4-year cycles? Probably not, right? Let's keep moving here. Mid-cap U.S. stocks, S&P 400 index, the Jan Brady's of the world, as my friend JC likes to say, just put in new highs in the S&P 400 index. Mid-cap stocks finally getting above the highs that they put in right after the 2024 election. That was a buying climax post-election in 2024 for a lot of things. We're going to see it as we continue on here. But mid-cap U.S. stocks are in an uptrend, and importantly, they are breaking out of this base where they've just kind of been trending sideways for a little more than a year. That is positive for the mid-cap space. Small caps, Russell 2000, similar story, much longer base. All right, we're talking about small cap U.S. stocks have gone nowhere for 5 years, right? They haven't made any progress in price in a number of years since October of 2021 was that little failed breakout right there, I guess you would call that, right? You had kind of gotten above these former highs, had a little failed breakout, boom, it got pretty rough. No progress for a long period of time. Finally, above those former highs. I think that's super important. But small cap U.S. stocks in an uptrend, you need to own them. Perhaps we need to own more of them. So we're talking about these relative trend changes that are potentially upon us. Here we're looking at the small cap index, Russell 2000, relative to the S&P. It is finding some support at the levels where it troughed during the peak of the dot-com bubble, which was the last time when small cap U.S. stocks had dramatically underperformed their large cap U.S. counterparts. Is that a surprise that they're finding support at the similar level? I would say no. There's a lot of market memory here. And so we need to be paying attention to this. Investors need to be paying attention to this. Nobody's wanted to own small cap U.S. stocks. They've been terrible. If you're a buy and holder, small cap U.S. stocks have done nothing for you for a long time. And so we see more and more people talking about when you have people come in with their 401ks, they are S&P, large cap growth. That's what they want to own. That's where the strength has been. Things may be changing, right? You may be picking up pennies in front of a steamroller. Be careful. International stocks, developed international stocks, as we said at the top of our discussion, they outperformed in 2025. Remember, they weren't supposed to because of all the problems, because of the tariffs, the trade wars. Did you hear about that? That was supposed to be a real headwind. That was the boogeyman. Don't own them. Guess what? Leaders in 2025. Very strong uptrend. Here's the thing that I'm going to say is the most important piece of this. As we define an uptrend here at Reveille using our rules-based investment discipline, this is going to be one of the only asset classes that remained in an uptrend during the Liberation Day sell-off. That is relative strength. You can't find that with any of these other asset classes. It stayed turned on, any other equity asset classes. This is a real positive. And they were finally able to eclipse their former highs from 2007. So important. So important. We're talking about haven't made any money in a long, long time. But I think that the fact that these are above these former highs, there is now technical support for being long developed international stocks. I don't think it's a surprise that as these eclipse their former high, that we started to see the relative trend move in favor of international. Okay. Now, I want to come back to Russell 2000 here because they are just now on the cusp of, they've staged this breakout from their 2021 highs, not as long of a base, obviously, as developed international. But I think that this breakout could be as significant as what we had in developed international. And given the fact that we see on a relative basis that small caps are trying to dig in relative to large, this is a chicken or the egg type thing, right? Are small caps going to dig in relative to large because they're above their prior highs, and that former resistance is going to turn into support? Or is because they are going to dig in on a relative basis, is that going to be what keeps them above these prior highs and moving higher? We're going to see. But all that to say, you got to own some small cap. Now, emerging markets, they have just, I'm talking about in 2025, they have just started to eclipse these 2007 highs. Such a big deal. Such a big deal. Because here's what's ironic. On a relative basis, okay, EM in an uptrend, you would have wanted to own EM. But these 2007 highs, you got to be careful or expect some volatility as we're dealing with those, as we're dealing with that resistance. But on a relative basis, we see that EM is outperforming S&Ps. This primary trend where S&Ps have been outperforming the rest of the world, right, including emerging markets for so long, that trend has rolled over now in favor of emerging markets. And I would have said coming into this discussion, and this is a conversation that we have as an investment committee here at Reveille, we want to be overweight emerging markets. We want to own more emerging markets if and only if we're above these 2007 highs in the emerging market index. So important. On a relative basis, the trend has already moved. It moved back in Q3 of 2025. But we didn't have the price support yet in the index itself. Kind of ironic that we've had the price support in developed international for 6 months above those 2020 or above those 2007 highs. We've been above that. But on a relative basis, it has not yet flipped in favor of international from S&Ps. I think it is coming. It's only a matter of time. This one already flipped on a relative basis, but the price hadn't confirmed yet. We're getting that now. This is a huge deal. I cannot stress this enough because people don't own this in the quantities that they should, if they own it at all, because they've been disappointed with any allocation that they've had in it for the last 15 years, right? Almost 20. Can you imagine? All right, let's keep moving here. We're going to talk about bonds. So we did get a rate cut from the Fed in December, number 6, if you're keeping count. However, what I find kind of ironic is since that first rate cut that we got from the Fed in September of 2024, 6 rates cuts, 150 basis points down in Fed funds. Well, the yield on the 12-month bill and the 2-year U.S. Treasury, they are down slightly from where they were going into the first Fed rate cut. But that is certainly not the case when you go out the yield curve. The 10-year yield is 50 basis points higher, 0.5% higher today than it was in September of 2024. Doesn't sound like rate cuts to me. Right now, obviously, the Fed, their monetary policy doesn't control what happens out the yield curve. Some of their balance sheet stuff is going to have some influence on it. And so I think the curtailment of their quantitative tightening is going to be a big deal. If we see these rates fall, if we see these longer term rates fall, I think that's a big boom, or it's a benefit for consumers, small business. Now, is it happening because of some sort of monetary policy type thing? Is it a growth scare? That probably isn't good. If it's a growth scare, maybe the stock market doesn't like that. Bond market doesn't care, growth scare or policy change, whatever. The price of bonds is going up, has been going up for really all of 2025. And so we'd say you still want to continue to own bonds, right? You want to have some bonds in your portfolio. They have been basing, though. They've been going sideways for 3 or 4 months. I think there's a probably decent move coming here in bonds. I can't tell you exactly what direction it is, but we want to, again, align ourselves with the primary trend. If the primary trend here changes and is now lower, right? We all know now, after 2022, bonds can lose money as well. So simply having exposure to fixed income is not always a recipe for de-risking your portfolio. You've got to do that by yourself. So right now, bonds are working. And if we see these longer term rates come down, that's a positive here for bonds, for bond prices. But if for some reason they can't and bonds roll over, look out. All right, we're almost done here. Commodities finally broke out. The commodities index broke out of a range that they've been in for several years. So commodities super hot post the election in 2020. Again, ironically, we thought that the Biden administration, or the concern was that they were going to ban the fossil fuels. And there was so much supply of crude oil that the May 2020 crude oil contract traded to negative $37. It was the most ridiculous thing ever. I remember us laughing about it, that I'm pretty sure the textbooks always used to tell us that the lowest price you could get to was $0. Apparently that is not the case. But here in commodities, after that big run up that they had, and ironically enough, kind of peaked out not long after that whole Russia-Ukraine conflict started. That's when oil had spiked back up to around 120. And that was kind of the peak of that move in the commodities index. But it's been the precious metals that have been carrying the way here. But on the whole, I tell you, commodities look good. I bet my buddy Steve Strazza would like this base right here. No progress for several years, just been going sideways. We've bumped up on that level a couple of times. We've finally broken out here. This is in an uptrend, but we're taking out those former highs. That's bullish for commodities. We're going to end here with real estate. There's just not a whole lot going on here with real estate. It's just trendless. It's going sideways. So, again, having exposure to REITs, real estate, not necessarily a bad thing. You're not getting hurt by owning them right now. And maybe, we're going to have to see how this resolves, right? Is it going to dig in here? Is it going to start to take off? Would be great for people who own REITs. But if it turns south, then not an environment to own REITs. So, all right, we're just going to wrap up here. Just kind of recap what we talked about today. Even though there were a lot of concerns, similar, it was just a redo of 2017. Everybody was scared to death about tariffs and trade wars. Obviously, we saw the climax of that in April of last year. But there was supposed to be the death knell again for international stocks, and they brushed that whole thing aside and outperformed in 2025 handily. But in addition to the rotation that we're seeing into international, we are also seeing happen in large cap value. We're seeing it in small and mid cap stocks. And I'm not trying to go out on a limb here, but what JC always used to tell me is that when you have something that is underperforming, that it's going to underperform many of its alternatives. So you've got the S&P, which has been the leader, and it almost feels taboo to say this, but it's underperforming developed international, emerging markets. It's starting to underperform value stocks. It's starting to underperform small cap. Is it going to start to underperform commodities again? If it's starting to underperform all of these alternatives, the last thing that you want is to have it be the largest position in your portfolio, which I'm telling you by default in your 401k, it probably is. So be aware. We got another rate cut from the Fed in December, but that has not helped the longer-term interest rates yet. They have not come down. And we've got some tailwinds here for the market over the next couple of months, but things could be choppy here in 2026. I'll tell you, in the very near term, the next few weeks, the thing that concerns me the most is that we have that continuing resolution that got passed, that temporary continuing resolution that was passed before Thanksgiving. It's due to expire on the 30th of January. That thing ain't getting extended, my opinion, without some meaningful rancor. The political environment in this country, it's not one where we're working together across the aisle. And so when we end up with another government shutdown, I won't be surprised if we find out that the one that we're probably about to have when this CR expires at the end of this month, that one turns into the longest government shutdown in history. I wouldn't be surprised by that either. So, all right, guys, this is the review. So again, you can, in very short order, you can look at the key asset classes that comprise your portfolio. Large cap U.S. stocks, mid, small, developed international, emerging markets, REITs, bonds, commodities. You can look at those charts, and in 5 to 10 minutes, you can discern. Your eyes won't lie to you. What's the trend of these asset classes? Are they up? If they're up, I want to own them. If they're sideways, I could still own them, but I don't want to own them if they're going down. So you can check that real quick, right? Is your portfolio aligned with those trends? The other thing you need to check is, are you aligned with the change in relative trend that seems to be happening in earnest right now? And that is that owning large cap cap weighted U.S. stocks, it may not be all that it's been cracked up to be over the last number of years. And don't accept that it's just going to continue to be that way. I wrote a white paper about that called Pavlov's New Dog. Reach out to us. I'll send it to you. It's also on the website. But we got to challenge those preconceived notions. All right, couple things. Make sure you're following us on Twitter. Subscribe to our Reveille YouTube page, Reveille Wealth Management YouTube page. You're going to get the latest in all of the content that we're posting on there, monthly reviews, podcasts, otherwise. The other thing that I would love to be able to do, send us an email, info@reveillewealth.com. We want to do a mailbag type segment. So your financial advisor, investor, business owner, whatever it is, that you've got some challenge that you're facing out there. And maybe you want to have, and you don't have to have any specific numbers, just general discussion here. You want to know what an experienced financial advisor thinks about that. How would you handle this situation? Okay. Send us an email with some details about that. Just give us a synopsis. And then in our future shows, we're going to pull one or two out of the mailbag and say, hey, somebody wrote in, they had this issue. Here are our thoughts on it. Maybe consider these things. These are the things that we think are most important to try to resolve that particular issue. So, all right, everybody, thank you so much again for tuning in for this latest installment of the $1 Million Question. I've been Stephen Weitzel. Thank you so much for joining us. We will see you next time.